We've made it to the second week of September, and pay attention, interest rates are dropping. Mortgage rates plummet to a new 2025 year low after an anemic jobs report. Of course, that's the flip side of the coin, right? Is to get the lower rates, you kind of need some bad news in the job market or in the economy, but rates are definitely trending lower. Let's take a look at that. So, this is as of Friday. So the 30-year fixed rate mortgage right now is below 6.3%. The 30-year FHA and VA loans are just below 6%. They're now at 595 and 597. So these are the best rates we have seen since about September last year. And last year, you might remember the Fed actually started lowering their rate in September. Now, there was an election going on, there was a lot of other things going on. But ultimately, while they were lowering their rate, our rates actually shot back up towards 7% again. So fingers crossed that there's enough data now to help the bond market kind of soften. That's why you're seeing these rates also come down. So let's go look at what's happened over the course of the summer with the rates. This is the 30-year fixed rate mortgage. When we started the summer, we were basically at 7%, and we spent most of the spring in the 7% range. In fact, we've spent most of the last 3 years in the 6 to 7% and above range. So we started the summer coming out of the spring right around 7%, but over the course of June, they dropped to about 6.75 as a range. As we got into August, we kind of were mid sixes, and then here we go, boom, boom. Last week we really saw another quarter point kind of collapse out of the market. So the good news is if you are already a buyer in the market, these rates are really going to help you. If you are a seller, I don't expect we're going to see a big wave of buyers coming into the fall market. What I do think is going to happen is the buyers who were already planning to buy are getting a little bit of a boost. That's helpful to them. And I think next spring, if this trend continues or can stick, then I expect the next spring housing market will be better for sure than this year, because interest rates could be a whole point or more lower than where we were in 2025. All right. Well, here's where we are right now in the metro. So we're leaning obviously to a buyer's market, and depending on where you are, what neighborhoods you're in, it could feel like an extreme buyer's market, especially in luxury and condos. We're seeing a lot of inventory there. Other parts of the market, I'd say, are more balanced. I wouldn't say any part of the market is a seller's market, but I would say you're either in a balanced area where maybe things typically will sell in 1 or 2 months, and then you're in other areas where they may never sell. There's so much inventory. So if we look at supply, this is the metro. So the blue line is this year, the dotted line is last year, and all the gray bars is our 10-year average. So, going back to August, our average is about 9,400 homes. And we're sitting probably, if I look at the data, it's above 15,000. So we're probably a good 50 or 60% more homes for sale than even our 10-year average. So you have more sellers on the market. You can clearly see the bell curve. We've peaked, and this year you're going to see fewer and fewer listings coming to market. Also, you'll have some properties sell, some withdraw. And so we're naturally going to see the amount of listings on the market continue to go down, probably through December and early January. If I look over on the demand side, and again, the gray bars is the 10-year average, we're pretty neck and neck with last year, maybe a little better. I'm going to move myself here. So again, if I look at August, we sold 2,700 homes last year, 2,500 homes the year before, 2,500 homes, 2022, 2,600 homes. So it's really only in the pandemic. We're neck and neck with 2016, 2017. So really just that pandemic, that little end of 2019, 2020 through 2022, that's where we saw just crazy numbers hit the market. And that's when the rates, of course, were their lowest. But demand is below average, supply is above average. Easiest way to remember that. All right, this is where we stand again on inventory. If we get down into September, we're sitting right now, this is just single family homes. This is actually Austin, Houston, and San Antonio data, but it's going to trend pretty similar. So this is going to be, you can see you hit a low in December. We peak typically in June, July, and we're already seeing the slide down. So I forgot to shrink it to Austin, but I can tell you the numbers are going to look pretty similar. You're also peaking on sales typically around May. And again, we're going to see sales do the exact same thing. They're going to trend down as we get into these last 4 months of the year. Here's the big question. This is Austin. This is our historic sales price trend. Can anyone guess where the pandemic was? Wow, so hard to find it. There it is. And so, anyways, all this is pre-pandemic. Okay, so you can see Austin was appreciating every year. You go up in the spring, down in the fall, up in the spring, down in the fall, but it doesn't fall as much as it went up, and that's appreciation. You're kind of bouncing uphill. And so, anyways, we were appreciating 5 to 8% on annual. We got to 2020, and it went almost straight up because once people realized we weren't all going to die of COVID, they got pent up in their house and they all went and bought a house, and then it just went ballistic and got too crazy. But here's the thing. Everybody is measuring Austin's fall to the peak of this little spot right there, 550,000 median home price. But the challenge with that is we didn't actually live in this universe that long. Like, it really sucks. I get it for everybody that bought in that window. It is going to be a challenge to get home values up there. We didn't actually live in that window very long. If you go back to the beginning of 2020, just 2 years earlier, we were way below. So it's this one group right here, maybe 21, 2, and part of 23. If they're trying to sell right now, they're struggling because they might have debt that's too high. They may have paid too high. They're struggling. If you bought it anywhere before that, you're fine. Austin has obviously come down. The peak of each year, here's 22, 23, 24, and 25. Each of our peaks has come down, but it's really kind of starting to go sideways. The lows have come down a little bit too, so we haven't quite flattened. But if you look at it kind of from this bird's eye view, it's really not dropping like that. It's bouncing kind of sideways with a little bit lower lows each year. And so Austin's really starting to find its footing after we've had the price and the interest rates and the property taxes and the insurance and the lack of buyer demand. You stir all that up in a soup, and Austin's just starting to tell itself, okay, we're just going to kind of hang out here. It's going to soften, but it's not going to soften hard. We're kind of waiting for one of three trends to take place. One of them is going to be the job market. Can the job market improve? The second trend is going to be, can interest rates continue to get better, which will spur more buyer demand? And number three, can supply tighten up? All three of those are kind of the factors that are going to drive this ship. It's a mix of supply and demand. That's going to dictate what happens next year. I do think we've passed the peak of our supply glut, meaning we're not building as much new stuff moving forward as we did the last 3-4 years. So I do think the supply glut is probably behind us. And I'll show that to you next in the rental data. So this is national rent growth, not Austin. So if we look at rent growth, what's happening nationally is it's really it's slowing down. And a lot of that's the job market. And some of that's also inflation. Inflation cuts down the amount of spendable money you have, because instead of spending $100 at the grocery store, maybe you're now spending $150 to buy a pretty similar basket of goods. Well, that's going to reduce the amount of money you have, and it's going to make you want cheaper rent or renew your rent at the same rate. So what we're seeing is rent growth is really coming down nationally. Now, Austin has been leading the nation for a couple years on rents coming down because we added all these new apartments and we had to reduce rents to fill them up. One thing that is good, here's San Francisco. Their rents are going up because they don't build anything. And then you got Miami over here where they had the opposite. It had a huge spike in rents, and now their rents are softening. But this was the total chart. Austin's in here. Where are we? Right here. So our rents dropped a tiny amount, but year over year, they're up about 2%. And our 2 bedrooms, this is 1 bedrooms, our 2 bedrooms, we went up a little bit as well. I wouldn't read into these numbers too much, but what surprised me a little bit is they're positive numbers. And so that might be telling me that, yes, it still hurts out there. If you're a landlord, you're trying to get your property leased, it does take a long time. This year, I don't think you're going to feel it get better, especially if you're owning if you're not the owner of one of these big mega complexes, you're feeling it in single families, duplexes, condos. It's going to take a minute, but I do think we're getting closer to the bottom on the rents. Austin might be turning a corner if we're starting to get better demand fill up for these units. So pay attention to that. If you are a seller right now, you have a few tailwinds and you still have a big headwind. The tailwinds is you might have your buyers in the market a little easier time financing your house because their rates coming down. And number two, you're not going to have as much competition because we're in that cycle of the market where you're starting to see properties shrink. You're starting to see neighborhoods have fewer listings. So those things work in your favor. The biggest headwind is that I don't think the story of more buyers and less supply is going to start until next year. So I do think we've got to continue to be really attractive, either on price, condition, or both. And the market's going to dictate what they want to do with your property and bid on it. If you're a buyer, I would say it in reverse. Your window to be alone might be shrinking. And so I think you've got a good window if you're a buyer, probably for the rest of 25, not to have too much competition. But if you are sitting on the sidelines and you're waiting for headlines for the Fed to lower the rate and I don't know what you're waiting for, but if you're waiting for something and you think it's going to be better next year, that probably also means you're going to have more competition next year too, because everybody else thought the same thing. So I'm excited for my buyers that are in the market right now, because I think you're getting a window where you may have an opportunity to be buying market, Austin, where it's starting to stabilize, not a lot of competition ahead of when the next, I'm not going to call it a surge because I don't think it's going to surge back to life. But when the market starts to improve, I think we will have passed the bottom. I hope that makes sense. Anyways, if you want to follow these videos each and every week, make sure to go to my YouTube channel, click at Ryan Kelly Group, and you can click that subscribe button. Would love to have you follow us. And of course, if you know somebody looking to buy, sell, rent, or finance here in Austin, would love to set up a call and visit with them. Anyways, Horns won this weekend. It's going to be a good week. And we'll talk to you next Monday. Thanks.